right. Hello, everyone. Give it another minute here and see if we get anybody to show up. I know most people said they wanted to watch it live via YouTube or the recording, but we got a couple people joining us here in Zoom. Thank you for showing up, and we'll leave time here at the end for any questions or additional comments from folks on my team. And I believe we are live and good to go, which means I don't need to record this then, right? Cool. There we go. Somebody else. Cool. All right. Everybody hear me okay? Pull up the chat. Cool. All right. Well, hey, everybody. This is Scott Tucker, and really excited to be launching something we've been working on for a long time. And this is kind of stuff we've been doing for years in a way. I just never packaged it in such a way to specifically talk about what I deem to be the coming retirement crisis. And there's some things we'll unpack. There's a lot. I tried to keep it as simple. Hold on, we got one more person coming in. Okay, cool. I'm trying to keep it as high level as possible because there's a lot of new information. So don't expect that some things might need to come back and do a little more research on as well. But I definitely want to make sure we're introducing our community to what's coming, and especially given what's happened here in the last, gosh, it's already been 6-7 months already, right? And so it's getting kind of crazy out there, and I think more and more folks are showing their concerns, and they've been asking us about it. So we wanted to spread the word a little bit more. So thank you so much for joining us here live. For those who aren't live or watching via YouTube, hello to you as well. And we'll get started. So here's a question, we're getting asked or people are talking about. We've been working for a long time and putting my money away in savings accounts and retirement accounts, more specifically for this presentation. And what I mean by a qualified retirement account, that's just the legal designation of saying that a qualified retirement account based on IRS guidelines and stuff gets certain tax advantages one way or the other. That's where you hear things about Roth IRAs, their savings plan, 401ks, and so on, right? Whether it's traditional, you're getting taxed later, or it's Roth, you do the tax now, that kind of thing. So that's specifically kind of what we're talking about here. And so this guy, his name is Raoul Pal. He's the founder and CEO of Real Vision, which is a macroeconomic, advice company, or they put out, their what they think is happening in the global economies. And there's lots of folks that do this. I mean, whether you follow Warren Buffett or Ray Dalio or any of the other folks who do stuff like this. But his presentation on YouTube, you can Google it, called the Coming Retirement Crisis, was something I had just never seen before. I've been in this industry for 12 years, and nobody was talking about demographics. And I was like, holy cow. And that's what his presentation is about. It's all about demographics, about the population, about which groups of people are having most influence on things, right? And I remember I had read a book shortly after 9/11 by a guy named Mark Stein called America Alone. And it was all about demographics, and it was talking about how the Western world was having less babies. They're just having a declining populations because of birth rates. And, that book specifically being after 9/11, it was talking about, hey, how the Islamic world is having a lot of babies. And as they're moving into Europe and stuff, that's what he said. The demographics are going to shift simply because of more babies. And so I'd always had that in the back of my mind. And when he started talking about it, when it comes to, people saving for retirement, I was just blown away. I couldn't believe that nobody else had been talking about this stuff. And so I started following him very closely and analyzing what are these risks and how can we protect against it? And so what is it? Well, we see this chart on the right. This is just showing the different birth years, the amount of birth. So it's like when we talk about the baby boomers, we kind of joke about it, our parents or something like that. Oh, the baby boomers, they're funny or they're goofy. Yet we never actually think about what does that mean? The baby boomers. Yeah, a bunch of people had babies after World War II, but look at these charts. It's a lot. And this only goes to 1980. And like I said, from that book of America alone, America's birth rate is down to 2.2%. It basically just sustaining the population. So these numbers have actually gone down even more. So the baby boomer generation is a huge part of our population, right? And so what he says is that the retirement crisis is going to be the biggest theme of our generation in the next coming decades, and basically mostly talking to Gen Xers. And what happened was when the baby boomers started coming of age in the early 70s, they started getting salaries, right? And so they started buying stuff. And so all of a sudden there's a whole lot more people buying things, and that created a demand for more goods. And so in the 1980s, it caused a heck of a lot of inflation. You've probably heard about the high interest rate environment back then. But the bottom line is more people were buying more stuff. And it caused a lot more money to go around, right? And at the same time, Wall Street recognized that these corporations who used to have pensions for the retirees, it used to be you went and worked for a company for 50 years, work for the steel mill like my grandfather, and then get a pension when you quit or retired. But the problem is a lot of those corporations were going out of business. They couldn't pay their pensions, or it's very expensive. And so Wall Street saw it as an opportunity to go to the government and say, hey, let's do something to fix this so that the government doesn't have to, basically take on the burden of these retirees' pension plans and bailing those out. And they said, we'll change the system. We'll create this retirement plan system, things like 401ks and IRAs and stuff, and we'll add tax benefits to incentivize the population to save it, to use them. And that way, instead of the corporation being responsible for the employees' retirement, this is the same thing they did with the blended retirement system in the military. They made it sound like they're empowering the individuals. Really, they're just trying to take money off the responsibilities off of their books for future costs and stuff. And so they created these retirement plans, 401ks, with the government to incentivize Americans to now save more of their salary and put it in the stock market, but actually, or save some of their salary. But the point was, Wall Street was saying, hey, we'll get you 7-8% returns in your retirement plan as you save for 20, 30 years, and we'll get you more money. So don't worry about that. You don't have to save as much as you normally would. I mean, years ago, when people would save, before there was inflation, before there was a need to have to grow your money, people literally saved it under their bed, right? And so it was there when they needed it. And so now Wall Street was saying, hey, give us your money, we'll grow it for you. And that way you have even more money to spend. And so this created a huge stock market boom because just all sorts of people who weren't investors before, and now there's more of them as well, started to participate in it. And so we've seen how that's gone since 1980. I'll show a chart here in a bit. But at the same time, they also came up with the idea, Alan Greenspan, and I don't remember which president, but pretty much all of them were saying, hey, all Americans should be able to buy a home, right? So you should be able to easily get a mortgage to buy a home. So a mortgage is one example of credit, but all sorts of credit became more and more available. And so this created really two booms, a credit boom, because the Wall Street firms and banks, they're making money from the credit too, right? So it created these huge bubbles. And we saw what happened in 2008, if you remember, in the mortgage loan crisis blew up, and then the stock market crashed as well. And so why is this important right now to think back about those last crashes? Because in 2000, those baby boomers, that huge red block of folks all started to retire, meaning they started to sell their investments because they needed to use it for income to live on. And it started in 2000, but now they're all starting to retire. And the numbers around 10,000 a day, baby boomers are retiring, and they're going to need to start pulling money out of the market to live on. And they're also living much longer than anybody ever anticipated. And so as they withdraw from the market, they're who's going to fill that gap to keep the growth going? Well, it's up to the millennials, really. They're the next generation entering the workforce, who's making money, but they got problems as well because they got student loan debt. They really don't get jobs that pay the salaries to justify those student loans, and so they're not able to save very much. So this is a problem. As people are withdrawing, there aren't enough as a greater population is withdrawing. And looking back at the census history, we're seeing how much greater that population is. And what this chart is just showing the number of people over 65. And a lot of this has to do with like healthcare. People are just simply living longer, right? So back then when they invented, Social Security, decades ago, they only thought people were going to live shortly beyond 65 because these were the stats, right? But the anticipated growth, of how much longer people are going to be living is huge. And so again, these are the baby boomers. So it's a huge group of people living longer than expected. And yet the younger working population, currently like the millennials and whoever's next, I can't remember what they're called, but they're decreasing. As we said, there aren't enough people entering the workforce. And so this is a serious problem that most aren't considering. There's a bigger population that is going to rely on a smaller population to fund them, right? That's what entitlements are. And so when we think about something like Social Security, I was looking through an old presentation I made way back in 2009. This is an older statement. But I thought it was relevant because I remember in this presentation what this said. And I just pulled a quote from the statement. Unfortunately, I went online to look for a statement. I couldn't find one from 2009. But I remember pulling this quote out that said, in 2017, we will begin paying more in benefits than we collect in taxes. Without changes, by 2041, the Social Security Trust Fund will be exhausted. Like that was right on everybody's Social Security statement in 2009. So I was like, okay, that's still relevant today, because we've already passed 2017, and that means they're already paying more benefits than they collect. So that's interesting. But then I thought, well, okay, well, what do recent statements say? Well, I went and found a 2015 one, and right here, changed the language a little bit. Without changes in 2033, the Social Security Trust Fund will be able to pay only about 77 cents on the dollar for scheduled benefits. And then 5 years later, just this year, they don't mention it at all. They simply say, hey, by the way, you need to have other stuff saved besides Social Security. So we always joke our generation's not going to get to see Social Security and don't really think about it. Hey, don't plan for it. And yeah, maybe this is evidence to say, that's the case. But either way, I mean, just think about how the baby boomers are getting to take advantage of all these benefits. But then we think about what's going on right now and the fact that we've had a 12-year bull market. It's kind of, people are always wondering, like, when is there going to be a correction? Because in the financial world, we always expect every 5 or 6 years there to be, some correction, not always a big crash like happened in 2008, but a correction. And since 2008, it's just gone straight up. And even with the lockdown, we've now come back to all-time market highs just last week. Because back in March, when they first started the lockdown, there was about a week where the market lost 30%. And most people didn't notice because we were freaking out about the virus and what the new world was going to be like. And then slowly the markets come back up. It's like, how? If everybody's out of work, if the economy's going down, how is the stock market still going up? Well, it's because the bailouts that everybody thought they got a nice check for every couple weeks or however they signed up for the unemployment benefits or through their business, even if the business got a bailout to help fund the salaries from the PPPs, that was actually a pretty small percentage of the amount of money that the Federal Reserve printed it, because most of the American people, they gave the money directly to the American people because they knew they were going to use it to go buy stuff and keep the economy going. But most of that money actually went directly to corporations. And what the corporations started doing is they started buying back their own stocks, right? So that does two things. One, it allows them to divest of many shareholders that would have otherwise have a say in their corporation. They bought that stock back, but then it also inflated the stock market, because it's basic economics. When there's high demand for something, when you're buying more of it, the price goes up. And so now all these corporations with billions and billions of dollars just started buying back their own stock, and it made the market go up. So it looked like everything was hunky-dory, even though 30%, 40% unemployment was going on, right? Or we were looking at that. And just like in 2008, when they had to bail out the banks, they're doing the same thing now. The Federal Reserve, which again is not a government agency, it is a private institution owned by many of the big banks. And what the Federal Reserve did this time, not just bail out the banks, for the first time, this goes against the Federal Reserve Charter, but they were able to buy corporate debt. And that means the loans from they could basically lend money to corporations, and then also get exchange traded funds on the stock market, basically buy equity. The Fed is able to have influence in American corporations, and that's a dangerous thing. And it's kind of goes against what the whole point of the Fed was. And so they just printed so much money. I mean, we're looking at trillions of dollars just in the last 6 months, that a lot of it just ended up propping up the stock market. Okay, that when I say propping up, that means it wasn't because the companies are all doing awesome. I mean, other than Amazon, of course, and it just made it keep going up. But we want to take a look at, we understand that the past of the stock market has its ups and downs, but generally it always keeps going up, and so that's true. And that's how long-term retirement planning usually works. You just say, don't worry, over the last 40-year period of time, you're going to get 8% rate of return. And yet, as people near retirement, they start to look into this, say, hey, we're at these all-time highs. We've had 12 years of a bull market. There's going to be a correction at some point, because they keep propping up the bubble. When it bursts, it's going to be bigger than ever. But the market keeps going up. So if I'm afraid right now and I go to cash, and the Federal Reserve keeps pumping money in the market and it keeps going up, now we have FOMO. We have fear of missing out on the upside, while at the same time we have fear of losing because of the coming crash. Like, this has never happened. And the reality is it doesn't matter, because that's the market. This is the market, but this is not how the average investor invests in their various retirement accounts. And even if they are investing in their retirement accounts, what happens is people are human. They have emotion. And this is something called the Dalbar study. They do it every single year. And every year, the numbers change every year, of course. But basically what it's saying is, because of emotions, as those swings in the stock market go up and down, people move their money. They take it out of the market, they put it back in the market, and they always do it at the wrong times. Even though they say, buy low, sell high, that's not how the majority of humans work. They don't have that level of discipline, because they don't pay attention to their money that closely. I mean, it's a full-time job, right? It'd be crazy to be able to do that. And so they underperform the actual investment that they're in, because people don't just buy a S&P 500 index fund or put their money in the C fund and TSP and just leave it there. They see it go up and down, and they make changes all the time. And I put out a survey on LinkedIn the other day, and I was asking people kind of like, hey, how concerned are you about what's going on in the economy? And I just wanted to get a gauge. And I was kind of shocked that, over 50% of the people that responded are thinking like, nah, I haven't thought about making any changes. Like, given what's going on in the last 6 months, haven't even considered it. And it's like, oh, wow. I mean, maybe they're just distracted or not worried about it. But I just found that a bit strange, because I also asked, when people are thinking about their actual military retirement pension, there's a lot more concern than I had ever considered was out there about whether or not people are even going to get their pension. They're kind of worried that their pension might be like that Social Security fund. And I don't believe that. I think that would be the last thing to ever go, them not paying the veterans a retirement pension. But the point is, they're just noticing how much concern there is out there among veterans when it comes to their future. Yet when it comes to the actual part of their future that they can manage, their own money, half maybe aren't even thinking about it. So, typically, you go get help from maybe a certified financial planner, or a fiduciary investment advisor, or whatever, to help manage and make sure your portfolio is all set up right to handle all these things. And I'll just say, I was that guy. I was that guy for about 10 years. And, that's me in 2008 when I got out of the Army, and I went and got all the licenses, took the tests. They were sort of hard. Not really. I probably overstudied for them, bought the suit, put on the smile, learn the process that you're supposed to apply the exact same thing to everybody, like everybody's the same. And, there you go. I'm a professional financial advisor now. And it was nuts, because the reality is, I didn't know. I was just doing what my firm told me to do, which is really convince somebody they have a problem so you can sell them something. And really, we'd use this financial planning strategy of making sure you have balance. You got to pretend like it's a stool, and you got to have all your stools balanced, and you got to have the leg that handles the peace of mind. Make sure you have an emergency fund, get out of debt. It's like, okay, but I mean, we're adults. We should know that we need to have an emergency fund and probably not get into too much debt. But they don't teach us that in school. Wonder why. But then again, we also need to, we need to invest for our goals. We need to grow our money so we can accomplish our goals. And what are the goals of a typical financial plan? It's like, buy a house, retire one day, send the kids to college. And it's like, well, we're in America. You're kind of supposed to do that. And most people do. It's not that hard to plan for those types of things. But hey, you got to be worried about death, because if you get hit by a bus, your family's going to be destitute, or you might have a estate planning issue going on. So anyways, it just causes a lot of reasons to talk to people about a lot of different things, that causes a lot of confusion. And there's just so much, knowledge, perceived knowledge, that needs to be had out there. And so, hey, you work with a professional to understand all this stuff. And what I found funny is, even with all that going on, the vast majority of people's assets, if they are saving at all, are all in retirement accounts. Something that's 20, 30, 40 years away. Doesn't impact them now. They have very little control over how it's managed. They're really paying attention to it, yet that's where the vast majority of the assets are at. And I found that strange. I got frustrated when I would do this whole model with clients, and I came to find out a lot of them, retirement wasn't even a very big, important goal for them. But anyways, they still got the money in the account. And I was like, well, what do you want to do with it? It's like, well, I just don't want to lose it. Right. Either way, that's basic three-pronged strategy is kind of what you get when it comes to financial education, all across the board, whether you hire a professional, or you're reading a blog, or working with, somebody, a counselor on base to help. They're going to have a different way of looking at it based on their experience. And unfortunately, in this industry, there's a lot of dogma. And once somebody's chosen their way, they say this is the best way for everybody. It's like, really? Everybody? Well, anyways, I'm not here to convince people, but I am going to call bullshit, because I did that for 10 years and I just didn't see anybody really being motivated. They weren't motivated to accomplish anything. They were just scared more, thinking that they needed to save for this retirement, and they had really no idea if it was going to work out. And that's what I got frustrated. I kind of quit the industry, and I wanted to find a better way to do it. But yes, I'm a veteran. I went to West Point, served in Iraq and in Europe and stuff. But it's more, and I know there's a lot of veterans in the financial industry as well, but I want to do more than just relate as a veteran, because basically most veterans who get recruited into this industry kind of get basically like I was, get sold the story that they need to tell to the potential clients. And they don't have an opportunity. They spend most of their time out there prospecting for potential clients. They have that opportunity to do the research, to actually look at the issues facing military and veterans. And instead, they're kind of told the same story that was told 20, 30 years ago. It's like, obviously things have changed since then. I mean, the internet came, iPhones. And when I quit the industry, when I got frustrated, I just realized I need to find a better way. And I went and looked for it. I went to conferences like FinCon. I've read all sorts of books. I've been all over the website. I couldn't find it. I couldn't find something that would solve this unique problem facing the veteran community. All right, am I back? Okay, cool. Thanks. Sorry about that. Wi-Fi just dropped out for a split second. Cool. All right. So basically, I met a guy who was a financial advisor and convinced me to join the industry. And I got to do that over in Europe for a while. And because we were doing it in Europe around military bases, I was focused mostly on our community. So I got very good at understanding all the nuances that were going on. But like I said before, I recognized that we were all kind of given the same cookie cutter solutions, wasn't really solving the problems that veterans were having when it came to their military benefits. And that's why I created VetWealth, and I put all these logos up here just to show a little bit. Hey, we've been featured a few times. A lot of people are pretty excited about what we're up to. So we're driving forward pretty hard. But getting back to what would a traditional retirement plan look like? Well, if you whether you work with a professional or follow just some company's advice that you're buying mutual funds through or whatever, or one of those TSP investment Facebook groups. I find it fascinating that people give each other investment advice via Facebook group, but anyways, there's no one being held accountable there, that's for sure. But basically the bottom line is they say, hey, when you think about how much of which investment you're going to have, you're taking on a certain amount of risk for a certain amount of return, right? And based on what's called modern portfolio theory, they went back and looked at decades of the market performance of all these different asset classes, and they basically could say, hey, depending on which type of investment it is, you take so much risk for a certain amount of reward. And as long as you've mixed it up in a certain amount of asset allocation and certain amount of diversification, it's going to work out, and we'll change these as needed to reduce the risk over the years. And it's a good story. And yes, when just let ride for 40 years, the averages end up probably working out. I think comparing decades of returns before the internet age with decades returns after the internet age, and as our country has gone into crazy amounts of debt, $26 trillion as of now, not to mention the unfunded liabilities of Medicare, Medicaid, and Social Security, and so on. But either way, this is the story that gets told. And then they show you, these fancy graphs and charts and make it look like, hey, don't worry, here's your portfolio. And I remember I would have to give these to clients and sit there and be like, look, you've got so much in energy and technology sector and all that. It's like, what does this mean? Because guess what? The financial advisors aren't individually paying attention to all this stuff. Nobody can. I mean, that's what analysts on Wall Street, the people that get on the news, do. So anyway, it's all kind of a show to make it look fancy, but the real risk, as we mentioned before, is actually human behavior. Because I saw one of two things happen. Either people just kind of weren't paying attention to the risk, or they just go all in and kind of become a day trader, stock trader, realizing that when you're doing that on your own, you're competing against huge firms on Wall Street with technology to move a lot faster. People lose their shirts. And so, these are just problems that are hard to solve, but everybody seems okay going back to this model. It's like, hey, as long as you get that certain portfolio and can handle the volatility, handle the risk, then it'll work out. But humans get in their own way. because in this example right here, we're just using about $250,000 for this example. But the idea is, hey, here's a guy who needs to retire. He's got some money saved, but he needs it to grow more. It's not enough, right? So according to his financial plan, he's got to make 8% return to be able to have enough money to retire the way he wants. So he's got to put together a portfolio of roughly, that 80-20 bond portfolio, stock bond portfolio, in order to get that 8%, according to modern portfolio theory. Well, what that also states is that he's got to, over the short term, so this return is over many decades, to be able to average that out. Now, that's the accepted process in theory. But over the short term, in order to get that, he's got to be willing to risk negative 15% in order to gain 23%. So over a 6-month period of time, that's the level of volatility he's got to be willing to accept. And again, humans are either not paying attention, and then when they do, they freak out and start selling out at the wrong times, because when you look at the real numbers, it's like that's some serious stuff. Like $40,000 in 6-month period of time, that causes people to question their investment strategy and make changes. And that's how you usually end up with the head in the crocodile, right? So what's coming? Baby boomers are going to start using their massive wealth, as we discussed, to retire. So that's going to pull money out of the market. Now, they're also getting to dip into all the benefits first, and for as long as they live. And they're withdrawing all their retirement savings first. So they've gotten all the profits from this 12-year market, actually since 1980, this multi-decade boom in the stock market. They've gotten all the profits. Now they're going to start pulling all their money out first. And when that bubble does burst, and when there is a correction, however big or small it might be, when they start to go, ooh, I'm a little concerned about that volatility, I need to start pulling their money out, they're also going to be the first to go to cash. And after they do that, they're old. They need the money. They're not going to risk it back in the market. They're not going to put the money back in. And that's the demographic problem that I had never thought about until I saw that presentation from Raoul Paul from Real Vision. And so that was alarming to me. I was like, holy cow, this huge population, they're pulling their money out anyways. But once they start losing it in the market where they can't control it, they're going to want to control it. They like all their benefits, right? They like their control. So, and again, we discussed, once they pull that money out, and if the market crashes, how do we rebound the market? Well, we've got to have more investors put money in, but there aren't enough millennials, and they're not doing too well financially anyway, to be the group of people to save enough to rebound the market, right? So this has never happened before. And it's a concern that nobody's really talking about. And I think it's important that we understand. So what do we do about it? And then what do we do here at VetWealth? Well, we created something called the Retirement Rescue Strategy. And the idea is to just follow 3 simple rules. First one is we still got to beat inflation. We got to beat inflation because as the Fed's pumping money in, the value of the dollar is going down. Right. So we need to have our money growing more than the inflation rate. Right. The other thing is we don't want to lose money. It's a pretty good rule when you invest in something, try not to lose the money. And the last thing is don't pay for stuff that doesn't have value. So looking back at the markets, this is the only game in town to get, for the average person to get some side of growth in their money. To some way grow their wealth. You can get into real estate investment, maybe do Bitcoin, start a business, but for the average person who needs to have somebody else manage their money or have some other vehicle grow it for them so they can beat inflation, this is the game in town. But, I like to say most people are playing. I think it's still a gamble at the end of the day, but it's the only one we can play. So if you're going to go to Vegas, a lot of people play slots and lose a lot of money. Some people who are paying attention and are smart play poker, and they don't play against the house, they play against each other. So if you lose, at least you know why you lost, right? The other thing is don't lose money. And this isn't as important during an accumulation phase, because if you are disciplined when the market drops, if you listen to what they say is, hey, hold on, it'll come back up, or even better, buy more while the prices are cheaper. But what about what happens when the market drops when you're actually using your money? And this is significant. Now, what these charts are showing is basically these return numbers here are the same. Okay, that's how we get the average 4%. The difference is they're reversed. On this scenario, got $100,000 invested. He's pulling out $5,000 a year as the market continues to grow, right? So that's about 5%. 4 or 5% is a good rule of thumb for a withdrawal rate in the financial planning world. They say, hey, if you withdraw 4 to 5%, your account won't run out. That's the theory, at least. Unless it just so happens that in those first few years that you are withdrawing your money, there is some negative years. And if there's negative years when you first start pulling the money out, the account depletes even faster, and we can end up with less amounts of money. So notice this guy was able to maintain some value. Totally, this one's going to go to zero. Regardless of how much better it performs in the future, it's just too much to rebound from, right? So sequence of returns risk is something that gets ignored a lot, simply because most people don't even think about it because they're mostly focused on saving money and not too worried about what happens when it comes out. But the bottom line is, if the year you need the money, the market's down, you can't, what are you going to say? Just, hey, I'm going to wait till next year, see if it comes back. It's like, no, you need the money. That's the whole point of saving for it, is retirement funds, right? The other thing is the fees that Wall Street and its underlings are taking from investment accounts, whether it's a 401k or a mutual fund or a financial firm, they're still really high. Usually in the 1 to 2% range. If you're going to work with a professional, you're going to pay that. If you're going to do it yourself, you can get index funds and pay much cheaper. But I put a couple of fund examples here. This one's like 0.6%, so pretty cheap comparatively. And this one's, I think, about a 1.5. But either way, in over a 20-year period of time, now this is showing an investment with future contributions. I can't remember what number I put in there, but hey, all right. 20 years later, we got $900,000. I think he's putting in like $10,000 a year or something. Got a lot of money saved, but we've also paid pretty high fees. I mean, that's $90,000 in investment fees just to basically have them change those asset allocations around every so often, which really artificial intelligence can do that now for a fraction of the cost. I don't understand the value in that. And I know I used to be on this side of the thing. This is how I got paid. It was the only way I knew how to make money after the military. So let's look at the different types of vehicles and what you can typically get from it. So we got things like TSP, 401k, IRA, compared to our strategy. And inside these are usually the investment accounts. And so you can get market growth from all of these strategies. But when it comes to downside protection, to protect against losing money in the market, we don't get that from the traditional retirement accounts, because the only way to have skin in the game inside these accounts is to be invested in the market, typically, or at least that's what's assumed. With our plan, we actually have insurance on the downside. We buy insurance on the stock market so that if it goes down, we don't lose. Okay, we're doing this using insurance companies do this at a massive scale. This is very popular. It's usually popular for people in their 70s and 80s, or at least it was for the longest time. But with modern technology, it's now more available. Low fees. TSP has got the lowest fees all around. 0.03%, I think, is what it was recently. 401ks, sometimes there's hidden fees in those that can be quite expensive. And just depending on what you have in your IRA, there's obviously going to be fees involved. Ironically, with this plan that we're going to talk about here in a minute, used to have crazy high fees. They invented the Tesla version of it and actually has 0 fees now. So there's no gas. You don't got to pay for gas in this plan. So that's really cool. And the other thing is, with the risks of what happens when you pull the money out, can you guarantee, and especially with people living longer than ever, not saving as much as they need, can they guarantee they're going to have enough income? You can't do that with any of the other traditional type investment. Yet with the insurance companies, they can guarantee that you will not outlive your income. It's just part of the algorithm they use. So the big question is, wait a minute, how do you get market upside growth without any risk? Because that's what our strategy offers. And like I said, new technology, like anything, whenever there's new innovation going on for the last 20 years. This innovation has been happening in the financial industry. Most people aren't paying attention. They're doing it the old way they always have, and they don't want to change because that's how they're making all their money, and they're used to it. They're comfortable with it, right? But I saw what they were doing. I'm not the innovator. I'm the early adopter. And for the last few years, I've been researching and implementing this stuff with our clients and recognizing that more and more veterans are coming to us now, and they're becoming part of the early majority. And I think this is definitely what's happening in the financial industry the next decade. And I think it's very important that veterans be the leaders on the front here financially, because our country needs more veterans financially stable so they can take positions of leadership and not feel like they just have to sit behind their cubicle for so long. But so what happens when we're buying insurance on the market so we can get growth without risk? Well, really what they're using is what's called a long-term options contract. They look back at 1 year, 2 year, 3 year increments, and they simply say, hey, did the market go up that year? Cool. We get to lock in the gains. If the next year the market goes down, we just don't execute the option and don't take the loss. Goes up the next year? Cool. Lock in the gains, and so on and so forth. And the opportunity there is just taking out the volatility. The end returns can be better. Sometimes they're about the same. But the key is just not to lose the money, especially when you need it, but let alone, at any time, even if you're in your 30s, if you've got a good chunk of change saved and 40% market drop happens, there's a concern there. The other thing we don't have to worry about is timing the market. Like, I know a lot of people with their TSPs, they're always talking to me like, ooh, yeah, I sold out in January. I was smart, but I'm going to get back in once the COVID's over or whatever. It's like, listen, nobody knows how to time the market. Some people do well at it. But a lot of times when people are bragging about that, they don't tell you about the times it didn't work out, right? So take that into account. And the other thing is, there's a lot of things to worry about. There's plenty of stress right now already. I mean, just getting our kids back into school is crazy. To worry about, again, most people's savings, the majority of it are in their long-term retirement accounts where they're taking huge amounts of risk, and don't have time to pay attention with it. But the chaos is happening anyways. And we want to make sure that you've got a plan for no matter what happens next, because nobody saw this lockdown stuff coming. So I don't know what else they could do to make this more difficult than it needs to be for everybody to be happy financially. So what are we doing? What we're doing is we're creating what's called a private retirement pension. It's also known as an annuity. Like the military pension is an annuity. Again, if you read like Susie Orman or whatever, they're gonna hear the word annuity and they're gonna freak out and talk. And again, that older technology, wasn't as good. Worked for some people. It was perfect for some people, usually people that are older. But the newer versions are completely different, offer the same benefits with better options, right? So what we're doing is we're basically creating an insurance contract on your savings. Okay, so we basically guarantee your savings. Any money you have now that goes into the contract is guaranteed. There's no risk of future loss. So you put 250,000 in on that day, you're locked in at 250,000, can't go down. Cool thing is we got the index crediting strategy. We're buying options on the market. Could be an index like the S&P 500. And when it's up, we get the gains. When it's down, we don't. We don't get all the gains. That's how the insurance company makes money. It's kind of like if, say your buddy is a really good real estate investor. He likes flipping houses and he gets a good return on the flipping the houses. And you want to participate in that return, but you don't want to be the dude, flipping the house, having to find the house, having to get the loans, having to gather the money. But I have friends who do this. And a lot of veterans do this. I mean, active duty passive income is a huge group of military and veterans who do real estate investment. And what they do is when they find a property, they post in the group and say, hey, I found a property, who wants to invest in it? And a bunch of people raise their hand and they'll throw like $20,000 at it. So, but the guy doing the property management, he's not taking that $20,000 and then charging them a fee to manage it. Like, no, the only thing he's doing is giving that guy a return on the investment once he gets his profit. And they split the profits. Wall Street doesn't do that. Wall Street gets paid no matter how well they do. Insurance companies invest your money for you. It's without risk using their strategy. It's like, what's the strategy? Real estate investment strategy. This insurance, this private pension is a strategy. And the way they make the money is they split the profits. That way they don't have to charge you fees. So this way we don't have to worry about running out of money. We can beat the inflation. Assuming inflation doesn't go to hyperinflation with this Federal Reserve funding, but that's a whole nother problem that unfortunately the dollar won't solve if it loses its value. But we can do our best to protect what we can for now. So let's look at a case study. I say we got a colonel around age 50. He's got some money in his TSP, did a good job, but he knows, to live the lifestyle him and his wife want to live, he's going to need to at least double this in 10 years and then continue doubling it, continue growing it, because it's not like he just hits age 60, wants to retire, starts pulling money out, lives for the next 30 years and forgets about inflation. No, we got to keep growing the money even when we're using it. That's why that sequence returns risk is so important. So he was if he was going to roll it over into an IRA or something like a 401k, when you get out of the military, you can have the option to do a transfer or rollover into different types of accounts. And 401ks, like I said, usually are pretty expensive. Very hard to access your money once you put it in a 401k if you do want to ever move it out. So keep that in mind. I never recommend people move money into 401ks. IRAs are different because it's individual. You get full control over what you do. Like if you have a TSP or an IRA, what happens is that's the designation. Our strategy actually would live underneath the type of retirement, the individual retirement account. So you get the same tax benefits. But anyways, if they were using a standard mutual fund option, they're going to be paying those fees. Going to have to take the risk of 70-30. So a little bit less than we showed earlier, but in order to get 7% rate of return, got to have that amount of risk in the portfolio. So building that portfolio requires, that 6-month risk frame of -12 to +19. So, pretty big gap in volatility over a 6-month period of time. That's a risk of potentially $31,000 in losses. So as he's saving for, getting closer to retirement, starting to be concerned about it, managed to save a lot of money without paying attention to it much, but now he is. And you're telling me if he takes a $31,000 loss in 6 months that he's not going to readjust his investment strategy? Unfortunately, he shouldn't probably if he was going to do this approach, but that's just not what happens. Most people will make an adjustment. And look what happened. This is just recreating if he'd have had this same portfolio during the 2008 crisis. So from October 07 to February 09, before the market started rebounding, about 18-month period of time, he would have had an almost $90,000 loss, right? So no way he would have stomached that. I actually remember this is when I got in the industry right here. And this is right about when people started freaking out. And so everybody, as the market was hitting the bottoms, that's when everybody started going to cash. And then when the market started coming up again, everybody was still in cash and missed out. So even though the market's all the way back, most investors that lost back here have still not made their money back. And again, if he did that traditional portfolio, he'd be paying a lot of fees on it. But, at the end of the day, he's doubled his money, a little bit more than that, over about a 15-year period of time in this scenario. And, these are the standard numbers. This whole scenario I've just laid out is accepted in the industry as a good approach. And like I said, I called BS because what happens if the market's crashing right when you need it? So back in 2000, this is my dad retired. He was so proud of himself. He'd saved $1 million in his TI. He was a football coach. He had TIA CREF. That's for like all educators. And he finally hit $1 million. He was so proud of himself. And I was proud of him. But it was in 2008, right when he went to retire. He was a football coach at Ohio State, actually. And what happened was right at that same time, Coach Tressel had done a troop tour over to Iraq. And when he came back, he asked my dad to stay on board the team and be a kind of military liaison for the Ohio State football team. And so he did some really cool things with that over the years, but he didn't want to. He wanted to retire, but he had to go back to work anyways. But it ended up working out being pretty cool. But what we see with our strategy, and what I'm showing here is just, one example of these indexes that we have access to. And what it does is that in the years that are down, we don't lose money. And sometimes we can even make money. Again, this is just one example. Most of the time in a negative year, we're sitting at zero. But it just depends on how the strategy works out. But these are past performance. These are actual numbers and how this strategy has done. And we just like the idea that, hey, when we have a negative year like 2008, where everybody else is losing a ton of money, we're staying flat. So in the long run, it doesn't necessarily even do better than you do in the market, but just the steadiness of the growth and the fact that there's the lock-in that you can't lose money at all. That's guaranteed. It brings a lot of comfort to folks. See, in the past, when people would use annuities, it was only not to use money, but there was no growth. So you couldn't beat inflation. Again, the new technology allows that. So, the whole point of retirement accounts anyways is to use it as an income. So we want to think about it that way. So looking at this scenario a little bit more, we got the $250,000 that he put in at age 50. And, based on, this is using the last 12 years of real market data, how this particular index performed. He got 6.65% of real return. Now, real return is different than average return. Whenever they show you these charts and they say, hey, the average return is this, that's not really accounting for the actual dollars, because if you lose 50% in the stock market, you have to get 100% of the market back to end up back to where you were. Okay, so it's much harder to get a real rate of return when you're losing money. The other part of the strategy is, remember that 4 or 5% rule of thumb of the amount of money that you can pull out? That's because the risk of your account running out of money. In these strategies, you're guaranteed the income no matter how low the account balance goes. That's just part of how the insurance companies are able to do this. They can guarantee that even if you live to 110 and your account ran out of money when you were 90, they've still paid you those last 20 years. So that's the guarantee that insurance companies can offer. And the other cool thing is, instead of only 4 or 5%, they can offer a higher amount. It all depends on how long you wait until you access the money. Okay, that's just part of the algorithms that they put together to make this all work out. And the other cool thing is there's a death benefit. Okay, unlike with a typical retirement account, if you pass away, it's got to go to your children or something. All of a sudden, it becomes a huge taxable event. Well, insurance products are tax-free. So whatever the balance is when you pass away, that's exactly what goes to your heirs. Cool. So anyways, that's all we got for today. Did just under an hour. That's why that's why I was moving quickly. I know there was a lot of stuff there. But if you want to see what this would look like for you, and again, this is one of our strategies. This is one approach I think is the most relevant for what we see in the coming retirement crisis for folks who are concerned about that kind of stuff. And so love to schedule a time to chat with you about it. I'll sit around right now and answer some questions. I want to let Trevor jump on, see if he wanted to add anything while we're still here. But if you need to go here at the 2 o'clock hour, totally understand. We only scheduled an hour, but I'll hang out for as long as folks have questions. And we put the link to the scheduling in the chat. Trevor, you got anything you want to add? Oh, you're unmuted.
Hey, no, Scott, I think you covered it. If you guys don't know me, I'm Trevor Maxwell. I work with Scott at VetWealth. I'm a retired Navy EOD guy, and I worked in the industry for a couple of years in some of the more traditional firms like what Scott talked about. And, same kind of story. I got sick of like the way people were doing things, and I tried to find something better. And so Scott and I have known each other for a few years. I came to work with him, and he's not kidding. When you look at it from our perspective in terms of like what's important, it's, to me, there's a really good book out there written by a guy named Don Blanton called The Personal Economic Model. And the thing that always stuck out in that book to me was when he said, there's more to be gained by avoiding losses than there is by picking winners. And that's kind of essentially like, that's at the forefront of what this strategy does.
Cool. We had one question asking about why one of the charts showed a negative return. Again, that was one example of of one of the various indexes, and that particular index doesn't follow. I'll go back to it. This particular index isn't linked just to the S&P 500. This one actually has its own version of asset allocation, and that's how they were able to get positive returns even when the market did negative. If we were doing this strategy with only the S&P 500, we would have just had zeros on these years. But in the up years, we might have gotten a little more, right? So anyways, those are the options available. It just so happened one of their years they didn't do so hot, but that doesn't mean that this strategy would have lost money. It's just the actual index that they are following didn't happen to make money that year, right? So there's different investment strategies out there. This one by JP Morgan just happens to be one where they invested in a way where there's a lot less risk. And, but they don't get those big upside years, right? You're not going to see a positive 26, 30. Some of these years we've had recently, they're pretty darn good. We get decent returns on average, a lot less volatility. So if you were doing this index in the market, this is how it would look like. Your money would be directly invested in the market. In our strategy, we also have the protection of the insurance company. Cool. So we partner with some of the, and by the way, we partner with, over 70 financial firms that we have access to, hundreds of various products. And so we've already shopped the market and found the best ones, and can, just depending on people's individual situations. Cool. Well, if we don't have any other questions, then that means I did an awesome job, and everybody's going to come and schedule an appointment with us. Now, just kidding. But no, hey, one thing I do want to mention, I got my book coming out. We just got the initial advanced copy back from my editor this week. It's called Veteran Wealth Secrets, the post-military guide to preparing for the modern economy. And just really excited about this, but a ton of info packed in. It's already like 230 pages. We talk about everything from personal branding to financial strategies like this, to figure out what your passion is after the military. And while yes, we're talking to military folks, do we only serve military? No, of course not. You don't have to be in the military to work with us or to learn something from what we have. So if you know somebody who could benefit from this stuff, we'd love to have you share it with them and see if we can help out.
Hey, Dan, Al, Jason, thanks for showing up, fellas.
Hey, thanks for the invite, and appreciate all the info.
Cool. Well, thanks, man.
Yeah, thanks, brother.
Cool. Well, it's great to see so many people here live. I know it's tough. Well, I mean, I guess it's a little easier nowadays to be able to come live on these things, but I know it's still, people are still very busy, but that's why we're created the YouTube channel. We're putting up tons of video. I got tons of stuff to upload on our YouTube channel. So Veteran Wealth Secrets on YouTube as well. We're going to be changing over a lot of our social media to that new moniker, as it seems to have resonated with folks. And so you find us on YouTube, Twitter, Facebook. Obviously, LinkedIn is a huge thing for us. I think LinkedIn is the most important wealth creation tool ever invented. Most people are just using it like a resume, and that's unfortunate. So we've got a course on how to use that better as well. So packed full of new ways to think about life in the modern economy. But cool, Jason. Hey, man, thanks for coming. Appreciate it. All right. Well, we are at the 2 o'clock hour. I'm going to log off now. Thanks again, everybody. And let me know if we can help you with anything.